Not all numbers are born for the balance sheet. Some are born to bring a smile. Some usher the future. Some make you stand tall. Some numbers light a fire and fulfill wishes. Some spoil you silly. Some echo joyful shrieks. Some numbers have smiles written all over them. Some make the planet happy. Some make the planet healthy. Some numbers rise against all odds. Some are made for dreams. Not all numbers are born for the balance sheet. As we spread our wings globally, we at Mahindra believe that the numbers we are most proud of are the number of lives we have touched. Mahindra, together we rise.
Good afternoon, ladies and gentlemen. A warm welcome to you back on this Friday afternoon. In our ongoing coverage on first quarter earnings, we bring to you one from an old private sector lender, DCB Bank. It was earlier called Development Credit Bank. Steady growth in net advances and deposits. There is a decent, strong momentum in the co-lending and construction finance portfolio. Operating expenses have risen a bit but are in line with income, and of course the capital position remains comfortable. The first quarter deposit growth is 20%, advances growth is 21% overall, and profit after tax is at 157% for the first quarter gone by, up 20% year on year from 131 crore rupees. We are now joined by Mr. Praveen Kutty, MD and CEO at DCB Bank. Good afternoon to you, Mr. Kutty, and a very warm welcome on Business Today Television. The numbers look fine to me at least, and I don't see any lines of worry on your forehead. How do you analyze two or three basic numbers for us? Profit after tax 20% higher, net interest income also surges. What were the two or three things that worked for DCB in the quarter gone by?
Good afternoon, Shailendra, and thank you for having me here. It's been a decent quarter. Usually Q1 is not the best of quarters for banks in general, but we're very happy to see that our growth has been consistent, 20% plus, in line with what we have been doing for the last 4 continuous quarters. There has been, while the growth is good, we're also happy with the bottom line mimicking the top line. The bottom line growth being 20% again. There were 2-3 things which were important, which I'd like to highlight in this quarter. One was that we have had 3 rate cuts, albeit at different points in time, adding up to 100 basis points of repo rate cut. During that time, we have managed to keep the NIM at 3.2%, which is about 9 bips lower than what it was in last quarter. And this primarily has been achieved because we've managed the cost of deposits reasonably well. Our top 20 ratio in deposits remains practically the same at 6.81%. So we haven't gone significantly high on bulk deposits. That's not our credo. But clearly, we are showing the ability to grow 20% with lower cost of deposits. So that would keep the bank in good stead going forward. And I would tend to imagine that the impact of repo rate cut would be reduced quite substantially, hopefully, by the measures that we're taking on reducing both cost of borrowing and cost of deposit. So that's one item. The second item, Shailendra, is that we worked reasonably well on keeping the cost to income ratio under control. Uh, the cost to income ratio currently is at 59.97%. It's 7 percentage points, 700 bips lower than what it was in the corresponding quarter of the previous year. Even if you look at cost to average ratio, we are at 2.52%, sequentially dipping for the last 5 quarters. So that's a story which is unfolding. We haven't seen the last of it yet. So both cost to deposit and cost to income ratio, the rein on managing the cost, are stories which will go well into the coming quarters and perhaps the year as well. Last part I want to tell you is that we've achieved this 20% growth in bottom line, despite providing substantial amount of provision for NPAs of unsecured lending that we have. And we have a small component of TA, securitization book, which is of unsecured nature, and also the MFI book, which is organically done. For both the NPAs as of March 31st, 2025, we have provided in full. It is a conservative measure. We think it's a prudent measure, and we're happy that we could do it and still maintain the growth pattern on the bottom line.
Mr. Kutty, this is what you talk about, the positives, and despite a soft quarter, despite the fact that you've had 100 bips cut in lending rates, you've managed such a fine performance. There is some stress that's building up on the loan side, especially MFI loans, especially gold loan NPAs, and the DA book that you talk about. Now, in the coming 3 quarters, when your liability side will also readjust because fixed deposits will get renewed, how do you see this loan portfolio stress either easing out or maybe remaining where it is?
On the specific segment, Shailendra, which you spoke about, I tend to think that the MFI pain will continue probably to Q4. Maybe the pain will decrease progressively, but there will be pain for the next 3 quarters. The unsecured DA, I'm not really qualified to speak on that because what we do as DA is frankly an experimentation. It's a sandbox in which we try new products. It's a testing ground. We test, validate, and either ditch or scale. So that's what we do on the DA pools. It's a good way to check out different products without rushing headlong into it. There also we see similar kind of pressure. But what was a surprise to me in Q1 was that secured DA, which is also a very small book which you acquired from multiple NBFCs, of a nature of ticket size of, let's say, 2 to 6 lakhs, is showing similar size as unsecured loans and probably slightly lesser than MFI loans. But there is stress in the market, regardless of whether it's secured or unsecured, at the smaller ticket size level. So I would tend to think that there is going to be pressure on that particular segment. Will that cascade to the normal average ticket size that banks like us do? At this moment in time, I would like to say unlikely. And from a go-forward perspective, our guidance always has been credit costs between 45 bips and 55 bips. I would tend to imagine next few quarters, we should be hovering around 40 bips of credit cost, even considering the environment that we currently have.
Mr. Kutty, when you talk about this stress between loan sizes of 2 to 6 lakh rupees, 2 other competitors of yours, one is Bajaj Finance, and of course the sector regulator RBI has sort of pointed out that there is something that's building up in the bottom of the pyramid, whether it's unsecured microfinance loans or smaller ticket sizes. Are you getting a sense that this is geographically distributed across your loan portfolio, or are there specific reasons where this pain is occurring?
Honestly, it's a mixed bag. It's a mixed bag because of 2 reasons, Shailendra. You look at the gold loan portfolio, between co-lending and organic book, we have close to 10,000 crore book.
Yes.
the incremental NPA on that book was 7 crore. And,
That's
and
nothing.
these are and these are 2 lakh, 1.5 lakh, 2.5 lakh loans, right? And these are in semi-urban India. We have 464, 465 branches all across. Every branch does gold loans. It's a very large spread out book, right? And we are not seeing uh, anything alarm. It doesn't keep me awake in the night at all. So to say that segment is going through the pain, there is a counterbalance of facts coming from the gold loan which seem to suggest otherwise. But clearly, there is stress we are seeing on the unsecured DA of small ticket, and also similar type of secured, micro lap, you may want to call it, by whatever name you call. There we are seeing the stress happening, but these are not our originations. So we are seeing it cherry pick loans taken after the minimum holding period, and then still you're seeing stress on it, which makes me believe that yes, there is stress on that particular book, but the gold is behaving very, very differently.
It's up 43% year to date. So you're under, your asset is secured, so to say. Nevertheless, let's look at two other ratios. Interest income is rising faster than, my apologies, interest expense is rising faster than interest income, whether you look at it sequentially, fourth quarter to first quarter, or Q on Q, which is Q1 versus Q1. Will this result in compression of margins?
Uh, Unlikely, for a simple reason. The reason why the yield has come down on the stock book is because all the externally linked benchmark loans we have reduced the interest rate, the interest by various composition. It happened in three tranches. So as per each of the tranches, we have reduced for eligible customers in the last quarter. So you're taking that hit immediately. We believe that the impact of the management actions on the term deposit book will play out over a 15 to 16 month scenario. On an average or peak term deposit rates were in the 15 to 18 kind of category. It is kept changing over the course of the last year. So what you're seeing now is only the benefit which we had for a 3 month period, maybe. As we go deeper into the year, you will find more benefit coming in because earlier high cost term deposits will continue to get renewed at the similar kind of percentages, but at a much lower rate. So I don't think the story is over yet. We're just seeing the beginning of it. Some portion of what you see as a reduction of cost of deposit has come from savings account reduction, but the real that's perhaps only 21% of the book. The rest 80% is term deposits, and that story is an emerging story. And you will see that coming in all the way, probably even into quarter 2 or quarter 3 of next year. So there is more play there for reduction of the cost of deposit.
Mr. Kutty, you are not alone in this space when we look at how the CASA ratio is, dipping, whether year on year or Q and Q. That was because of what the RBI did upfront 2 months ago. But because you also said in your opening remarks you don't do much of bulk deposits, when do you see CASA stabilizing? And if at all by the fourth quarter, do you see an uptick?
See, on CASA, I have a slightly different view. And the view is hello.
Yes, we can hear you, sir. Please continue.
So on CASA, I have a slightly different take. Uh, the real truth of low cost funds will come from cost of deposit, because on one end of CASA there is a totally price inelastic set of customers, and the other end of CASA, which is a higher rate at much higher levels, let's say a 10 crore plus or a 50 crore plus, you have term deposit coming and sitting there, which gets a customer a very high rate of interest. So that's how the spectrum of savings account currently is working. So you can increase a CASA significantly by getting more money at the higher rate of interest, but that is not really CASA. So CASA bit masquerades the whole picture. I would tend to believe on cost of deposit because that clearly separates the wheat from the chaff. We're focused on it. But having said that, there is a lot of focus in the bank on A, current accounts, and B, savings accounts which are used for the purpose of transactions and for the purpose of normal banking rather than savings account as an investment proposition. So we are focused more on the flow than on the float, because any money coming into savings account because of the rate of interest or because they want the benefit of float usually is expensive money.
Okay. Like I said earlier, you are not the only one suffering this. We spoke to many PSU banks as well, and they are undergoing the same stress on CASA as you did. It's fine, sir. The nature of the savings bank account is changing over the last 5 years or so. A lot of people are now moving liquidity towards, mutual funds of different types rather than keeping it in simple fixed deposits or as simple cash in bank accounts. These are changes that all of us are grappling with. Now let's look at, come back to the good part, which is the co-lending portfolio. Tell us some granularity as to where this money is going, and is this something that you hope to expand in the second and the third quarters as well?
Uh, Let me answer the second question first. I
Yeah.
don't think we'll have too much of increase in co-lending in the next few quarters. In the first quarter, we concentrated on short-term loans and fixed-rate loans. In the second, third, and fourth quarter, you probably see organic loans coming up. As a bank, I don't see us crossing 15% of the total balance sheet of the total assets as co-lending book. Within co-lending, we would like to diversify even further. There are gold loan, there is educational institutional financing, there is some unsecured business loans, there are home loans, there is loan against property. So you have a whole variety of loans where we do co-lending. Our principle on co-lending is built on three fundamentals. We do co-lending of products that we don't have, or segments that we don't cater, or locations where we are not present. And the whole thought process being good fences make good neighbors. So if you want to really flourish the partnership, then there has to be clear boundaries set on what you want to do and what you don't want to do. And inadvertent stepping on each other's toes does not happen. So that's the way we want to build this co-lending book. We started co-lending as in India. Co-lending started in May 2021, and from in the last 4 years, I can see that the DC Bank's penetration of co-lending as an industry would perhaps be around 4.5%. Whereas if you were to look at the overall perspective, we should be around 0.2 to 0.23%. So we are punching much above our weight on co-lending. Having said that, there will be diversification happening on in terms of originators, in terms of the type of product, in type of segments, and also in the variety of locations. That's our thought process on co-lending. Overall, 15% of the balance sheet is a good thumb rule to go by.
Now, Mr. Kutty, we look at a set of issues which have, bothered DCB Bank for a while. I'll request the PCR to kindly fire the long-term chart of DCB Bank and look at the absolute undervaluation of the stock. Mr. Kutty, revenue 6,794 crores trailing 12 months. Market capitalization 4,200 crores. You are trading below book. Can you believe this?
Strange things happen. Usually, the efforts that you put in today, the results of which are seen later, and the market usually is late in knowing what is happening inside the company. The way I look at it is that keep the fundamentals going. Do the right thing by the franchise. Do the right thing by the regulator. Do not
You
play
have
the
been
gray,
okay.
and keep at it. Basically, it's a question of being consistent, uh, chalk in this kind of numbers quarter after quarter. We've done 4 quarters in a row. Maybe fifth, sixth, seventh, eighth quarter, at some point in time, the belief will come from demonstrated performance. If it doesn't, we have done something good for the franchise. We are at it. I think there is, as a company, we want to occupy a particular space, and that space is to be a full-fledged banker
Huh.
for the self-employed community across India. Currently, our customers are stamped as uh, home loan, forget home loan, HL customers, lab customers, CASA customers, TD customers. End of the day, they are self-employed people who have surplus needs, deficit needs, insurance protection needs, trade finance needs. We don't look at it in a holistic manner. And if we were to, as a bank, look at it in a holistic manner, then there is enough we can do from an ongoing perspective. Suddenly, the debate moves away from book value to what the market price is, or intrinsic value what the market price is, to
Mr.
what the
Kutty,
possibility is versus where we are currently. And that's a dream we are chasing. We are building a bank which will be truly a full-fledged financial supplier of a high quality to the self-employed base in India.
Mr. Kutty, you have been at it for the last 5, 6 quarters. You've been with DCB for 18 years. Before that, you were with Citibank. I am saying that the market is not recognizing the work that's visible to everybody. I mean, I have read your earnings for now, I think 10 years, if not more. And look at the fact that, even on a 5-year median PE, you are below that median. 5-year PE price to book, you are below that. My point is that I think there needs to be something that needs to be done for the market to understand that a private sector bank is quoting at a PE of 6.5, profit making, low NPAs, good growth prospects, and here we are just at, 160 rupees, no, 133 rupees today. So something needs to be done, be that as it may. Uh, Two more questions. How do you see uh, Q, Q3 and Q4 pan out as far as NIMs are concerned, as far as any guidance that you can share on net NPAs and gross NPAs?
I would tend to think that there will be a NIM uptick in
Okay.
Q4 definitely, and perhaps even in Q3, because the efforts which are being done on the cost of deposit and cost of borrowing both will see impact over a 6 to 9 months term. So that's the way we see the uptick happening on the NIM front. On NPA, where do you see it? Let me put it the other way around. I don't expect the credit cost to reach our lower threshold of what we said is a guidance. We always said that 45 to 55 bips is our guidance. I don't see us even reaching 45 bips in Q2, Q3, or Q4. On the NIM front, there's a caveat. I'm assuming that there are no fresh rate cuts going forward. In case there are, then we will perhaps have to recalibrate, when the NIM uptick will happen.
Yes, I think the governor at the Reserve Bank of India has done all that he could, and he's front-ended it in the early part of this financial year. The monsoons have been good, and Mr. Trump has given us just the right amount of anger to get this GDP thing up and running. And I hope that the market looks at this deep undervaluation at which DCB is at. And with that, Mr. Kutty, we'll call it a day as far as this conversation is concerned. I enjoyed it both on air and the one that happened before we went online as much as I hope you did. And we look forward to the second and the third and the fourth quarters.
Shailendra, what I want to tell you as a last piece is that what you can expect from this bank is consistency, is predictability, uh, and the last adjective is not a great adjective, but we strive to be boring and uneventful. To keep at it, repeat of the same thing over and over again. And at some point in time, somebody is bound to sit up and take
Yes.
notice.
Yes.
Till then, the franchise will deliver.
Yes, I hope the franchise delivers. I read a wonderful book about 20 years ago about banking, which said you have to borrow from X and lend to Y, and the difference is what you make, and you just need to do it regularly. With that,
It's been a pleasure speaking to you.
sorry.
It's been a pleasure speaking to Shailendra.
Yes, thank you so much, and I again look forward to the next 3 quarters. Here's wishing you all the best, Mr. Kutty.
Indeed. Thank you very much.
Okay. That, ladies and gentlemen, was Mr. Praveen Kutty, MD at CEO at DCB Bank. All good numbers, you know, decent uptick in loan portfolio, strong growth in quarterly profit, minor uptick in NPAs, and of course, you know, repricing of fixed deposits is happening, so CASA is a bit low, but extreme undervaluation. Bank which is available, a private sector bank, old private sector bank available at a PE of 6.5. If you look at the median numbers 5 years, the current PE and the current price to book is below the 5-year median, and you will not believe it, the book is the bank is trading below book. With that, ladies and gentlemen, we'll await another half an hour for the last half an hour wheel on the markets today. I'll be back shortly.
Not all numbers are born for the balance sheet. Some are born to bring a smile. Some usher the future. Some make you stand tall. Some numbers light a fire and fulfill wishes. Some spoil you silly. Some echo joyful shrieks. Some numbers have smiles written all over them. Some make the planet happy. Some make the planet healthy. Some numbers rise against all odds. Some are made for dreams. Not all numbers are born for the balance sheet. As we spread our wings globally, we at Mahindra believe that the numbers we are most proud of are the number of lives we have touched. Mahindra, together we rise.
Caught in the crossfire, a convoy of UN vehicles approaches a crowd